Hi, my name is Megan Schneider, and I have been asked to complete a financial analysis for my Finance 381 class. The purpose of this analysis was to pick 3 companies and determine which ones we would make a 6-month $1 million loan to, which companies we would make a 5-year $1 million loan to, and which companies we would be willing to invest 50% equity into. The 3 companies I chose to analyze were ExxonMobil, Charter, and DirecTV. Let's look at a little background information. ExxonMobil operates worldwide, specializes in petroleum and the production of oil and gas, and its top competitor is Sinopec Corporation. Charter Communications operates in the U.S. It provides entertainment and communication services to residential and commercial subscribers, and its main competitor is Comcast Communications. DirecTV operates in the U.S. and Latin America. It also provides communication and entertainment services, but through satellite, and its main competitor is Dish. Now we will look at short-term liquidity ratios in order to determine which companies we will provide a 6-month $1 million loan to. The ratios we will look at are the current ratio, which is the current assets over current liability. This tells us if the company is able to cover its liabilities with its assets. Then we will look at the cash ratio, which is cash over current liabilities. This tells us how much cash can be put towards the paying of current liabilities. And then we'll look at the quick ratio in retrospect to the current ratio in order to determine its dependency on inventory. The quick ratio is almost the same as the current ratio, but it excludes inventory. It's the current assets minus inventory over current liabilities. This graph shows the current ratio for all 3 companies over a 5-year period. You want the current ratio to be high as possible to show that it can cover its liabilities. In this case, DirecTV has the highest of the 3 at 1.27, and it is the only company of the 3 that is able to cover its current liabilities with its assets. Followed by ExxonMobil at 0.82, and Charter at 0.23. This graph shows the quick ratio for all 3 companies over a 5-year period. You also want the quick ratio to be high because it is used in comparison with the current ratio. So you look at the quick ratio, and it looks like DirecTV is the highest again at 1.07, followed by ExxonMobil and Charter. This graph shows the 2 ratios together in comparison to determine how dependent on inventory the companies are. ExxonMobil has a high current ratio of 0.82, still not high enough to cover its liabilities, but significantly higher than the quick ratio. With such a big variance, this tells us that ExxonMobil is heavily dependent on its inventory, which it is being an oil and gas company. Looking at Charter, we see that it also cannot cover its current liabilities and is very low. It is not dependent on inventory, however. It isn't that far off. DirecTV is the best out of the 3. It's the only one that can cover its current liabilities, and it's very similar in numbers. It's not too far off, which shows that DirecTV, being an entertainment company, is also not dependent on its inventory. I will not grant a 6-month loan to ExxonMobil because its current ratio is below 1 at 0.82, and in comparison to the quick ratio of 0.36, I see that the company is heavily dependent on inventory. Its inventory being oil and gas is scary because of price variance, and its cash ratio is very low, so it doesn't look like I have anything going towards my short-term liabilities, and I will not be able to accept ExxonMobil for a short-term loan. I will also not accept Charter for the short-term loan because of how low its current ratio and quick ratio are, and it also has a cash ratio of 0. It shows no cash flows towards its short-term liabilities, and I will not be able to accept Charter either. I will, however, grant the 6-month loan to DirecTV. It has a current ratio of 1.27, which means it is able to cover its current liabilities, and in comparison to the quick ratio of 1.7, this tells us that we aren't relying on inventory in this case, and it also has the highest cash ratio of all 3 at 0.67, which tells us that if it came down to it, they could devote cash from operations to cover its liabilities. I will accept DirecTV for a 6-month loan. Now we'll look at leverage ratios in order to determine which companies we will grant a 5-year loan to. The leverage ratios we're going to look at are the equity multiplier, which is assets over equity. This tells us how dependent on debt the company is. The times interest earned ratio is EBIT over interest. This tells us how many times a company can pay its interest with its income. ExxonMobil has an equity multiplier of 2, which is a very good number in any industry. It shows that it's not too heavily dependent on debt, but it also has enough equity to cover its assets. It has $2 for every $1 of equity, and its times interest earned ratio is very high. It is above average. The normal average for industries is about 35 to 38. At 89.69 is high. There may be some issues with how it manages its credit and debt, but as a creditor, I'm not worried about that. I'm only worried about if I can be paid back. With a high times interest earned ratio of 89.69, I know that ExxonMobil will have no problem repaying the debt in 5 years, and I have no problem loaning to them. I will not loan to Charter because they have a very high equity multiplier of 140.89. This means that they are heavily dependent on debt, and their times interest earned ratio doesn't back it up. They only have a 1.14 times interest earned ratio, barely being able to cover it. I just couldn't. Barely being able to cover their interest, it just wouldn't be ideal to grant them a loan. I will grant DirecTV a 5-year loan. Their equity multiplier was not listed. It wasn't listed because its average assets over common equity was negative. It was negative 4.88. Negative equity is usually a bad thing, but in this case, it's due to share buybacks. They actually bought back 60% of their shares. Their times interest earned ratio is 5.79. That means that their income is 5 times higher than their interest expense. Even though their equity multiplier is negative, their times interest earned ratio is high, and I feel that they would be able to pay their debt. Now we will look at the DuPont analysis in order to determine which company we will be willing to invest 50% equity into. The DuPont analysis is a breakup of ROE, shown here. ROE is the return on assets times the equity multiplier. For this analyzation, I did break up the return on assets into total asset turnover times the profit margin, and then here's the equity multiplier displayed down here. Looking at the numbers, you can see that DirecTV is doing better than the profit margin, and ExxonMobil has the highest return on equity and the highest total asset turnover ratio, as well as the most ideal equity multiplier. But we have to look a little further into it in order to determine which companies we would actually be willing to invest in. I will invest 50% equity in ExxonMobil. They have a high return on assets, 9.34%. It's above the industry average of 7%. Its return on equity is the highest of the three at 18.51. Its equity multiplier is 2, which is a good number in any industry. And its profit margin is 9.34, which is above the industry average of 6.33%. Its total asset turnover is also the highest of the 3 at 1.05. This tells us, this number and this number tell us that ExxonMobil is having no problem getting rid of their inventory. They're turning over that inventory and they're making profit off of it. We will also look at the price to earnings ratio, which tells us how much a company is willing to pay per dollar of earnings. As of 12/31/2014, the price to earnings ratio for ExxonMobil was 12.27. It grew to the current ratio of 17.28, and it is expected to grow. Considering the financial standpoint of ExxonMobil and that the price to earnings ratio is expected to grow, we should go ahead and invest now while the price to earnings ratio is low in order to create optimal return. We will not invest 50% equity into Charter. Its return on assets is negative. It has a negative 0.87% return on assets. This isn't good in any industry. This shows that they're not creating profit off of their assets, which is never a good thing. Its return on equity is also negative, 93.03. This may be because they bought Time Warner Cable with their stock, which also isn't a good thing. It's too iffy. We don't know anything about the company or its plans. It also has a very high equity multiplier of 140.89%, which means it's heavily dependent on debt. It also has a below average asset turnover rate of 0.44 and a below average profit margin of 10.66. Its price to earnings ratio is also not mentioned, which tells me that there's no earnings for shareholders in the period shown. Because there's no price to earnings ratio available, we look at the estimates for the following years. The estimates are there. They do predict that there will eventually be a price to earnings ratio. But because it's so far down the line, and I'm unsure of where Charter is going with buying Time Warner Cable, I'm not going to be willing to invest 50% equity into it. I will, however, be willing to invest 50% equity into DirecTV. It has a very high return on assets compared to the 2.65 industry average. Its return on equity is negative, but in this case it's because the company doesn't rely on its equity. They own 60% of their shares internally. The profit margin is 15.42%, which is above the 12.2 average, and its total asset turnover is 1.40, which is above the 0.46 average. Its price to earning ratio is at 14.84 and predicted to rise above 17. Since it is predicted to rise and in the near future, we might as well go ahead and invest now while we can, ensure optimal return. So I would invest in DirecTV. In conclusion, I would grant a 6-month loan to DirecTV. I would grant a 5-year loan to DirecTV and ExxonMobil, and I would buy 50% equity in ExxonMobil and DirecTV. Thank you.